Okay, how's everybody doing? Excited to talk about some private equity, private markets. So private equity, as everyone knows, has really been historically in the institutional space, and as we've seen, it's starting to really catch on in the RIA and wealth space. So what's happening is, advisors want to have a differentiated returns. They want to do something a little bit different. They want to go into private equity. They don't know where to start. And what happens is, if you don't know where to start, you end up crippling your firm because you've got subdocs all over the place. You don't know how to manage things. So what we're going to talk about today is how to begin with the end in mind, how to bring in technology to help you get into this asset class and actually manage it so you can create a scalable process. So today we're going to dig into that a little bit. What's happening right now is, regardless of your size, sourcing private quality deals, opportunities are very difficult. Onboarding investors is very difficult. Managing, reporting, compliance, and transparency, again, really challenging. So we're going to dig into a little bit of this today. So let's dig into it right now. So why is it so hard? Anybody that has actually been investing in this space realizes it's quite the slog. Why is it so hard to enter the private markets industry? So I'm going to start with you, Michael. What are some of the biggest on the investment side? You're at the front end. What's some of the challenges that you're seeing? The biggest inefficiencies you're seeing on the allocation side?
There's a number of bottlenecks that advisors will face when it comes to allocating to alts. Really, the first issue that they have to deal with is the investment minimum issue. A lot of these funds will have very high investment minimums, which also turns into a diversification issue. It's very hard to diversify a client's portfolio if the funds that you're looking to get them invested in have really high investment minimums. So there's really two ways that the market is solving that. The first is asset managers are now coming out with products that have lower investment minimums and are much more palatable for a high net worth or ultra high net worth portfolio. So that's one. And the second is the platform solution, the aggregation solution, where some of these more illiquid drawdown funds with $5, $10 million minimums are now made available to investors at $25,000, $50,000 minimums, which not only allows for the clients and advisors to get access, but allows for the advisor to actually build a diversified portfolio of the different funds that they want to get access to. I would say that's one core component, one bottleneck that advisors face. And then the other is going to be the general manual processes that the private markets, inherently investors have faced, where it's not scalable, it's very manual. It can take, days for an advisor to complete one subscription document. These can be 60 to 80 pages. So taking these frictions as much as you can down to zero is very important, because as we talked about in some of our prep sessions, these issues can snowball and they don't go away, and they actually become worse as the private markets program within an advisor firm grows.
Yeah, and then alts don't just come from Glass. So if you have all your alts through Glass, you might not need us. In the same way that if you have public market investments, you don't need us because everything comes via Fidelity, Schwab, a Goldman account. But if you or your clients have dozens, hundreds, thousands of alternative investments coming from Glass, Case, iCapital, directly from Blackstone, from Sequoia Capital, real estate investments, you sign a new client and they come with a few dozen alternative investments, then the headaches just compound. So you have dozens of platforms, if not hundreds, you need to log into to get all the documents. Then each document has a workflow associated with it. So you need to get all the K1s to the end accountants. Capital calls need to be completed, typically within 10 days. Then you need all the financial data from capital calls, distributions, and account statements to be able to report on and bill on those assets so that your clients know what they own. And then so you as an advisor can advise your clients and help them plan. And we find that a lot of our clients will not have visibility into the client's entire book of investments just because it's so painful to get that information. So we just see a lot of one-off, call it death by 1,000 paper cuts problems, which is part of why we did what we do.
Yeah, so you think about it is you acquire a new client and they say, oh, I have this LP thing over here. And so you want to be able to advise on it. So then what does that mean if you're going to advise on it? So all of a sudden now you have to get LP statements and cap call statements. You have to start managing it, especially if you're going to be billing on it. And what happens is people start to just, oh, well, we'll put so-and-so in charge of this, or we'll have an inbox. And then next thing you know, you're hiring more people to actually be able to manage this whole LP process. And it really is can really cripple you. So the idea of being able to use good technology on the front end, on the allocation, all the way through to the client experience is really, is kind of be game changing. And that is why, embracing good digital tools, especially in this particular asset class, which is just basically there's no standardization. Let's talk a little bit about scale. So the whole idea is you want to build a firm that can be scalable. People don't think about scale when they think about, hey, I'm going to go into alts or I'm going to go into private markets. You need to think about scale at the front end. So, historically, it's been, Michael, it's been really challenging to access and administer these funds. How does Glass make this process easier for advisors and their clients?
So to your point, scale is very important. I think one of the problems that we set out to solve for, 10 plus years ago was this idea of access, right? How do I get access to alts? That largely has been solved for. Right now, the pain points and the bottlenecks are around how do I continue to grow this offering in this program for my clients in a way that's palatable for me as an advisor in my firm. As you said, death by 1,000 paper cuts is very real, and still deliver a good client experience. So you have to take a lot of these fragmented components, and what we do is on the front end at least, taking a lot of these fragmented components of getting allocated to alts, i.e. long-form subscription documents, taking that down to one evergreen subdoc. We like to call it the TurboTax of alternative investing. So we can take the time for an advisor to complete their initial subdoc from a day to 10 minutes. And then the ongoing servicing of that investment is, we typically refer to it as data chaos. So solving for, the disparate capital transactions of capital calls and distributions, LP statements, K1s, all of that. Solving for all of those components, they're all equally as important, because if one, the weakest link is the killer for these advisors. So being able to have a program in place that not only solves today's problems, but continues to evolve with you as you grow is very important.
Yeah, and we hear from advisors all the time and clients who are struggling with the scale problem. I've heard advisors have to turn away clients because a key client consideration is, can you help me manage all my outside alternative investments and make that administratively easy for me? And have had advisors who don't have the level of scale and the level of capacity to do that for clients and aren't able to serve that kind of really high net worth or family office style client. Have heard of individual investors, high net worth family offices that decide not to invest in alts or decide to not invest in alts through a certain administrator just because that administrator's processes are so painful or they don't want another K1 to chase. And so we think it's really important to put scale in place or be able to buy capacity. Like we talk a little bit about, you can buy Arch to manage your alternative investments in the same way you buy AWS to have more server capacity. So that you don't get caught in a space where it's like, okay, in order to take on these 2 new clients or hire this new advisor, I need to add bodies in my back office. Those people stay for 2 years maybe in that role, because it's pretty unglamorous to have your role be essentially like chasing things that come into your email inbox. So really think about how we can help firms find embedded scale within their practices.
Yeah, please.
So I'll add to that too, we view alternatives as a way for advisors to be value add for their clients, and you can't be value add if you're heavily burdened with the operational component of doing alts. So we like to think we're unlocking the potential for advisors to create differentiated offerings through alternatives. I like to say we try to keep advisors in the advice business. You're very good at giving advice to clients and guiding them towards their financial goals. I don't know what we've seen is advisors typically aren't experts in operating, and being in fund management from an operational perspective. That's where we're the experts. So unlocking an advisor's ability to do very high value add work for their clients is a large component of our business.
Yeah, 1,000%. And then, we all know everyone's in the M&A game right now. So if you are starting to acquire firms and you're going to acquire a firm and then all of a sudden you're acquiring alts, I've seen, some aggregators who have 1,400 alternatives on their platform. So like if you're thinking about doing acquisitions and you're looking at bringing it on, now you have to think about bringing on all the operational burden that is part of managing these alts. So it's really, really, really important, again, to think about what you're trying to do, where you're trying to go, and what tools you should bring. Going into private markets is a great thing. It's going to be great for your clients, but it can, really take down your firm if you're not really thinking through your tech strategy in this space. So one of the things I want to talk about, I'm really big around client experience. Let's say you want to go into alternatives and the client's in, right? But if you are crippled by these alternatives, at the end of the day, your clients are going to really suffer. So, historically, many firms are, using outdated systems. So, Ryan, your website says you connect all stakeholders through one unified platform. Tell us a little bit about what does that mean?
Yeah, kind of going back to the Schwab example. Like, we don't think you should have to go to each asset manager's platform in order to get the updates from each asset manager. It's like private markets today are 30 years behind where public markets are, and we want to escalate bringing private markets into the future. Also, we think it shouldn't be so hard to report on this data and to have this data in whatever types of document storage systems you use, reporting systems, general ledgers, estate planning software. There's a lot of incredible vendors at this conference, but without having good data in those systems, every novel technology isn't that useful. So we really believe in this best-in-class ecosystem of the ability to go get every document from every portal, turn it into structured data, and then make that data available via API into any platform so that you can build on this information, you can use it within planning conversations, you can think about how it affects the estate plan of your clients, and especially as alts become a bigger portion of clients' assets, it becomes a much more meaningful element to make sure you get right. Because some clients might have as much as 40% alts, and some clients might be 3% today, going to 10 or 12%, and then that becomes a pretty important part to their overall financial life.
Yeah, so tell us a little bit more. So you basically can take all of this unstructured data and actually extract it, verify it. Tell us a little bit more about how that whole process works and where the operational hurdle that you're actually helping them solve.
Yeah, so today we're collecting over 100,000 unique alternative investments for our clients, coming from 561 different portals. So some you might be familiar with. There's like Interlinks, Carta, Data Exchange, Juniper Square. They all have a different user experience. And mostly someone needs to log into that platform in order to get a document, in order to do something with it. So we go out and grab all the documents same day as soon as they're available, pull all those documents into Arch. So now you have this portal of portals where all the documents live. You get a single summary daily email that tells you everything Arch has done on your behalf and even uses some of the latest advances in AI to summarize things like investor letters and some of the LPAs to give you insights. We're pushing pretty hard in the direction of how do we make it really insightful to understand your investments. And then all those PDFs are turned into structured data. So now you have all your capital calls and distributions as data that can be exported to your Adapar, Orion, Tamarack, Black Diamond, as well as the latest NAVs. So kind of giving you structured data and insights instead of clunky processes around having to go to portals to get PDFs out of them.
And one of the things is data is your biggest asset. People don't realize that your data that you have on your clients, that you have on your investments, that you have in your research, that is a huge, huge asset. And if your data is all over the place, it's unstructured, you don't know how to get it, you don't know where it is, you don't know where it's flowing, it's going to be a detriment. So you're really having a good data strategy and using good tools is going to help you. I'm going to go to you, Michael, a little bit around what is the, when we're talking about the allocation process, like you're turning things that would take 10 days into 2 days. Tell us a little bit more about how that works.
So when you onboard a client into a fund, there's really the two biggest pain points that you have to go through historically is going to be the subscription document. As I said, those can be 80, 100 plus pages. And then in addition to that, you'll have to do AML and KYC for that fund, which means the next client and the next fund, it's highly redundant, low value add work, candidly, for the advisors and the folks that work at the advisory firm. So what we've done at Glass is, we've created this really turnkey platform that allows advisors to get their clients allocated to alternatives through one single subscription document. We've whittled that down into a digital process, i.e. the TurboTax of alts is what we call it. It takes 10 minutes per client, and it's only done one time, which is key because alts not only cause issues on the front end, but then as you continue to allocate, these issues, they're redundant, and they just get worse and worse. So by nipping things in the bud as quickly as you can and giving advisors an efficient way to do things one time, on the front end, as I mentioned, saves days of time just on one fund for one client. So now that we're talking with advisors that are allocating to 10 plus funds a year, oftentimes more, and not just for 5 clients, but for hundreds of clients with these larger firms, sometimes thousands, that can be a significant amount of work on the front end just to get your clients allocated. As Ryan mentioned, Arch is pulling documents from 500 plus portals today for RIAs and family offices. So these pre-trade and post-trade components, if advisors aren't proactive about how they're handling these, they'll run into them eventually, and they can become a significant issue.
Yeah, knowing when you can get into the fund, and having all that kind of figured out on the front end. Because what happens right now is you're basically going to be working with your clients, trying to look at what's available out there. Then you have to read through the sub-docs that are 1 million pages long, know when to get in. Again, it just erodes your scale. It erodes over time. It continually erodes your scale. So really thinking through solutions that can take you from allocation all the way through execution is going to be key. And really that's why the idea of embracing digital tools before you're knee deep in it is a good thing to do. However, there may be plenty of you that are already allocating. So one I want to talk about is, okay, now that you're knee deep in it and maybe your stuff's all over, how do, change is hard. Sometimes it's really hard to sort of change the ship a little bit. So I want to ask you guys a little bit around, when choosing a platform, where should they start their journey? I'll start with you, Ryan, when they're really, let's say they're knee deep in it right now and trying to do a transition to an Arch.
Yeah, it's like all dieting advice, like the time to start is now, essentially, because then you get the most benefit over the longest period of time of being able to amortize that solution. So we were talking to a client this morning, and they're like, yes, we just bringing over an $800 million family office, and these people bring this box of rocks. They have all these outside investments that we don't know what they are and how to price them, and that's what this helps us with, is being able to move from not advising on these assets to being able to advise and build on these assets. So then there's a lot of actually revenue driving that we can both bring into your organizations. But we know that the hardest part of using every solution is getting started with a solution. You don't want to be a year and a half later, only halfway onboarded, not really seeing value, not have your team trained on whatever solutions you end up buying, which is why we focus a lot on how to get started. Our biggest cost center as a company is customer onboarding, which we take on as kind of our own internal consulting project in order to make it as easy as possible for the firms that use us, whether they have hundreds or tens of thousands of alternative investments, to have a highly structured process that you don't have to run. You just need a point of contact so we know who to work with, and you can have someone quarterbacking the process internally to make it as automated to actually see benefits, because our focus is we want to allow you to see value within your first quarter and start to really save meaningful time so that your investment in a platform like Arch or a platform like Glass can really pay off and pay off quickly.
How about you?
Something that we can bucket advisors really in 3 different verticals, if you will. And every advisory firm is nuanced and unique on their own, but we talk to 3 types of advisors. The advisor that comes to us and says, I'm new to alts, or I'm generally new and I want a way to allocate. The second is an advisor that is, I've done some alts, I want to allocate more, and I'm looking for a way to do that more efficiently. The third is, and the most common conversation we've had, is an advisor that's been doing alts for a number of years, It's grown. The processes are now unwieldy. Their pain is significant, and they need a way to keep scaling the program because their clients have demand for it, and it's a way for that advisor to add value. But they need a solution to take them out of their existing processes. Those conversations we're having a lot of today. As this world has evolved, allocation in alts for global wealth has gone from generally less than 1%. Now it's close to 5%. It's probably going to 20% over the next 10 years, or close to 20%. Yep. So it's, global wealth is going to be a force multiplier and large allocator to the private markets, probably just as important as institutional allocators. So advisors have to be proactive. If you know the dollars are going to flow to private markets, you might as well make it a value add component of your practice so that you can, if you're doing M&A, you can attract advisors to come join your firm. You can recruit advisors, as well as recruiting and attracting, net new clients that are going to want a differentiated alternatives offering. You can do that in a way that's scalable for your firm so it doesn't burden you down the road.
Yeah, I think that you bring up a great point because, we want to attract clients, you want to attract advisors, and if you're doing M&A, you want to attract people to your platform. Your platform is just as important when you're trying to attract an advisor or trying to attract an M&A target is what are they coming into? Do you have you have access to alternatives? Do you have great technology that's going to actually give me scale and be able to offer more to your clients? So it's really important to think about what are you building into, and really taking some time to think about the technology that's behind your firm. Because what I see a lot is they'll just throw a person in the back office at it, and then they don't really understand what's going on, and they're all over the place, and everybody's busy all the time. And ultimately, it will impact your client experience if you do not have this thing really well dialed. So what I want to talk about now is we are at Future Proof, so let's talk about the future a little bit. Kind of what's next. When you guys take a look into the future, beyond what we've discussed, what trends do you see shaping the future of private markets?
Yeah, well, I love what Michael's doing at Glass, because I imagine that before someone like a Glass, when an advisor is filling out their subscription documents, they're like crying to themselves saying like, yes, it's worth the 11% over 7%. So there is this like reason to invest in alts, which is you want a higher return, these assets that are a little bit more stable in terms of their mark to market. And so as more advisors want more of the 11% instead of 7%, I think that will just create a lot more adoption of alternative investments. So we see this ship just continuing to run. And it'll be, also as you look at how advisory firms are consolidating, you now have this situation where it's not just like one vehicle a year or a few dozen or a few hundred alternative investments. Now it's like a much bigger problem. And as Michael mentioned, alts are now about 5% of a lot of clients' portfolios and climbing. Then I think it becomes really important for firms to be able to incorporate that into their more advanced planning and be able to bring more of the like long duration alt assets into a client's portfolio. So I think there's some really interesting things happening right now with like liquid alts and more ways that advisors can access alts for their clients. But we're really focused on how do we continually reduce the friction to make it as turnkey as I go into Schwab and I see my investments, I go into Arch, I see my investments, I go into Glass, I buy an investment. Think that these things should be very easy. Fund administrators should be able to like leverage tools like this. RAs especially should be able to leverage tools like this. And this shouldn't just be limited to the back office teams and giving them automation. We at Arch are really focused on how do we give the level of insights and data transparency that we can pull from these investments to the advisors themselves and to their CIOs and to the clients. So we're creating kind of a first of its kind digital experience around alts. And leveraging a lot of AI to do so, but just a lot of like really simple design so that it's not something you need to be trained on, so that these investments are easier to manage, better understandable, and then we ultimately want Arch to be a sales tool for our advisors to be able to say to their clients like, hey, by the way, that box of rocks you have with these various investments, we can simplify that for you and make it make sense and make it be actionable so that we can go get that 11% return for you instead of the 7%.
So you're more on the allocation. What do you see like truly in the private market space? What's next? What, from an investment standpoint, like what's the future looking like?
So I'll sort of cover off on the back half of Ryan's comments of the advisor can take what exists today as sort of like a maybe I have to do it, maybe I don't, to how can I turn this into a creative component of my business and have it help me attract clients and attract advisors. I think what we're going to see is alternatives programs at advisory firms are going to become highly customized. You're going to see a significant amount of expertise coming out of the advisor network when it comes to alternatives. It's going to be a great way to for advisor firms to continue to grow by attracting other advisors, be it through M&A or recruitment or getting other clients. But you're also going to see some, and we have seen this over the last 10 years really, product development one, and then sort of forced efficiencies when it comes to a lot of the frictions that we're solving for. So if you listen to any of these earnings calls from the publicly traded asset managers like Blackstone, Apollo, or Blue Owl, they spend a significant amount of time talking about global wealth. They really want to raise capital in the global wealth channel. It's highly important for them to continue to deploy the amounts of capital that they need to deploy to diversify their investor base away from institutions. So you're going to see a lot of product development coming out of that. We're seeing that today, semi-liquid funds, tender offer funds, and a lot of these products that platforms solved for on the drawdown side to make more palatable for the global wealth channel. Now you're going to see asset managers creating products specifically for the global wealth channel, the high net worth investors. So I think that's going to continue to grow and become a very big part of what's going on between asset managers and wealth managers is products specifically created for the wealth channel. And then some forced efficiencies around, ultimately the investors have the say, right? So if investors are, they're sick of getting a lot of K1s and they're sick of doing long form subdocs, eventually that will change and become more efficient. I think it's just going to take more time, and the role that Arch and Glass play is continuing to drive those efficiencies, right? We're sitting in between the work that's being done at the asset managers and the wealth managers, so we can see both sides and where the inefficiencies are. So you're going to, our platforms are going to continue to develop tools that ultimately makes the lives of the allocators much more efficient.
Yeah, and I think some of the why behind the growth of this market is also interesting, where it's kind of like there's three parties you could think of that it's in the best interest of. Like asset managers, their institutional clients are already maybe 40% alts or somewhere plus minus. So there's not that much more growth within the institutional space when these asset managers want to grow significantly. So they're looking for new sources of capital. And now it's like, okay, the RIA space and the advisor space is a huge new source of capital. And then if you're an advisor, it's like, okay, why alts? So I can give my clients a better return. And it's now a point of differentiation because most advisors aren't stock pickers. So when you think about investments, access to interesting alternative investments can be a major differentiator. And then for the client, higher return, more interesting. You have to deal with all this administrative pain, which is what we're both trying to solve, so that you can have those more interesting investments that yield at a higher rate.
So we can't be at future-proof without talking about AI. Why not? How do you think AI is going to play into the private market space?
Yeah, I mean, there's a lot of talk around AI. So we were meeting with a large asset manager, showing them our platform, and they're like, we've done dozens of demos. Everyone talks about AI. This is the first AI we've actually seen in action that affects the end client's experience. So we believe that there are a lot of really interesting applications for AI, not just being able to drive down costs of certain processes or querying information or the types of chatbots that you've seen, but there's so much information in this world today. There's a lot of information in subscription documents, in PPMs, LPAs, the decks you receive, all of the updates the managers send, and it's almost impossible for even the CIOs at these firms to be able to keep track of all the insights that are coming off of all this information. So we've designed some of our AI solutions to distill insights for CIOs, advisors, operations teams, and the end client to be able to tell those folks what's most actionable, what they need to know about their portfolio. So one example of that is we developed the first AI summary of investor letters and quarterly reports. And so if you're a client or an advisor and your clients are invested in alternative investments, every morning you get a summary of Arch of what did your manager say. So then you can start to spot, okay, when should I dig in more? What do I need to know about these different investments? And this also can really help when you're going to meet with a client and you want to come with some insights or really know what's happening, and you can kind of quickly scan through the updates and the summaries to have that level of knowledge as if you had an analyst feeding you data, but it's the AI feeding you data. We don't think AI is like the end all be all. It needs to work in concert with other systems and be engineered in the right way. But we think that it can really unlock a lot of value and a lot of insights for folks, and there's a lot of other applications to come.
What are you seeing on the AI front?
It's very significant. I think it's interesting. As Ryan mentioned, like everybody talks about AI, but it actually has to be practical, which it is for a number of use cases. But we always laugh that like nobody knew what OpenAI did until they launched a consumer-facing model, and now it writes everybody's emails. So it's nothing, then something. We use language models internally today for fund administration, accounting, employee communication. We have models that feed into different components of our research and due diligence teams to allow the advisors that we work with to pull down answers much more quickly. I think the biggest component to AI in private markets is the availability of information instantly. I mean, the power to pull down data in private markets has always been very fragmented, like data chaos, as we say. So the role that AI is going to play to make all of this data not only available but palatable and in a way that's like actually useful for the advisor is going to be hugely significant, especially for the client experience, right? Clients care about a number of things. They care about their investment returns, but they also care about, how are my investments doing? How can I see these? When can I see these? So the ability for an advisor to leverage platforms and leverage AI directly to pull this information down in a way that's fast, in a way that's accurate, and in a way that is palatable for the client, it's happening today and will continue to develop and will be largely significant.
Yeah, absolutely. One of the challenges I see is if you're not telling your client kind of what to expect, all right, we're going to be going into this, it's a different asset class. You're not going to necessarily see it on your custodial statement, or it may not match over here. So really being able to use your data that you have and to be able to explain the journey that they're going to go through. Because what happens is the clients will call in and be like, how come what's at Schwab is not matching with what's here and not matching what's there? You really need to have a good data strategy, and you need to use good tools, because ultimately you want to be able to answer the client's questions. You want to be able to set them on a path where they know what to expect in this particular asset class. It's super, super important. We've covered a lot today. I would say, is there one thing advisors and firms should take away from the discussion that we had, around basically this space? One thing we want to take away.
Yeah, I think you can turn alts from a challenge into a competitive differentiator in a couple ways. So it's like being able to sell to your clients, here's the product that we give you access to and how we simplify these different processes, and being able to come work with vendors like us that will collaboratively work with you around how can this help you grow your business. We know organic growth is a huge topic within the industry, and that's something that we want to be able to help you do more of. And so we're always happy to kind of work with you on how can this be a differentiator for your business, and how can this help you grow and scale.
Yeah, I would echo that. Allow alternatives to be a value add. Everything or most what advisors do for their clients is done on a highly custom basis. Clients want things that are different from the next client, and every client has different risk return profiles, and they need things in a different way. So alt should be no different. It should be highly customizable on a client by client basis. It should be a value add for you as the advisor to attract new clients, or whether it's to attract new advisors. So if there's one takeaway I would say is allow alts to be a value add for your practice, but be proactive about the tools that you're using today, knowing that the program is going to continuously grow over time.
Okay, well, we have a question. Yay. Okay. Do you think we'll ever reach a level of standardization in the private markets similar to the public markets?
Yeah, I think it's inevitable. It may take a few years, may take longer, but if you look at private markets today, that shares a lot of the characteristics of the mutual fund market, stocks and bonds just generally. You used to have to write a broker a letter to buy Coca-Cola shares or show up in person, and you'd get a physical stock certificate that you'd put in the bank, and it was like super manual. And now you can, for free, buy any security, sell any security, see what you own, find your tax documents. Public markets have come a long way. We think that private markets will have the same path, and there will be future ways, if we talk about future-proof, to get liquidity for your investments, whether it's being able to loan against investments or being able to trade out of positions, that will come. That you'll be able to buy investments with one click. You won't have to go through all the same KYC, AML problems you deal with today. Not that KYC and AML won't happen, but more that like it will live under the surface and be handled by the platforms that you choose as partners, and not something that you as an advisor or clients need to deal with. So we think that that gap between public markets and private markets will close, and will close pretty quickly in the next decade.
Yeah, I mean, I agree 100%. The market, is going to continue to drive that gap down. The allocators no longer want to, have to hide behind a curtain. Private markets, less so today, but 10 years ago was very much opaque, right, from an investor's perspective. Data was hard to get. I mean, even, today it's way different than it was 5-10 years ago, and 10 years from now it'll look very different. So investors are going to demand better liquidity, they're going to demand better data, they're going to demand better reporting. So the market ultimately will drive further efficiencies between wealth managers and asset managers, or even between investors and private market asset managers, where the delta between private markets and public markets will continue to get smaller and smaller.
All right. Well, that is it for this session. Let us know. Follow up with all of us right here. Happy to talk more about this, and have a great future proof. All right.